The most expensive problem in California home sale may be the thing nobody can see in the photographs. And it's not the kitchen, it's not the roof, it's not the interest rate. It's going to be whether that next owner can insure the house at a cost that still makes the payment work. We used to treat homeowners insurance like ordering coffee. You make the call, give them the address, then somebody starts pouring. Today, it can feel more like applying for permission to land an airplane in somebody's backyard. You have photos, roof age, brush maps, prior claims, electrical panels, tree clearance, sometimes an inspection, sometimes a refusal before the conversation gets warm. If we wait until the final week of escrow to discover that, we did not find a small problem. We found a locked door while carrying the furniture towards it. Good morning. This is your Santa Clarita Seller Intelligence Report for August 26, 2026. Today, we're going to look at the live market board, the pressure underneath the averages, what insurance is doing to buyer qualification, why a seller's current policy may tell us almost nothing about the next owner's options, and why I built my business so I never owe a buyer's agent, a buyer's referral source, or anybody else a favor when I'm protecting a seller. We're also going to talk about the artificial intelligence, but in a very narrow way. Not robots selling houses, not a glowing computer pretending it knows your family. We're talking about using private, locally installed analysis to see patterns that a human being can miss when 800 listings, hundreds of closings, insurance rules, financing changes, and neighborhood differences all hit the desk at once. The machine organizes the haystack. I still decide which needle matters, but here is the latest complete CRMLS snapshot available for this report. I pulled it this morning across the 9 city labels we track in and around the Santa Clarita Valley. 805 homes were active for sale. That includes the familiar community labels such as Valencia, Saugus, Newhall, Canyon Country, Castaic, Stevenson Ranch, Acton, and Agua Dulce. Plus the broader Santa Clarita label that can appear when a listing enters the shared regional feed through another board. I got shaved on my mind. The 9th label matters. Databases are literal. If a buyer's automated search is waiting only for Valencia and a property is filed under Santa Clarita, the house can be sitting in the building while the buyer is out looking in the wrong drawer. And it's like mailing a birthday card to the correct house with the wrong apartment number. The mail exists, the person exists. The connection doesn't happen. Now, for a seller, that's not a technology discussion. That's exposure. Of those 805 active properties, 121 were in backup position and 181 were in full escrow. Add them together, and 302 properties already had a buyer attached in some form or way. That's about 38% of the board. Another 14 are coming soon. By property type, 461 of the active listings were single-family houses, 208 were condominiums, 117 were townhomes, 19 were other residential types in the previous 30 days, 201 properties closed. Divide 805 active listings by 201 monthly closings, and the valley sits at roughly 4 months of inventory. That's near the line between a seller-leaning market and a balanced market, but a buyer-wide average is a blanket. It tells us the temperature in the room. It does not tell us which person has one foot hanging out. The clearest example is property type. The 30-day median for single-family homes was approximately $884,500, with a median 36 days on market. Condominiums closed at a median near $465,000 and took about 50 days to close. Townhomes closed near $590,750 and took about 26 days. That's the same valley, same interest rate environment. Condominiums were taking 14 days longer than detached houses and 24 days longer than townhomes to sell. If we tell every seller that Santa Clarita has 4 months of inventory and we stop there, well, we built a beautiful toaster and never plugged it in. It looks like market analysis, but it cannot make breakfast. And city by city, Valencia held 244 active properties. Canyon Country held 183, Saugus 105, Newhall had 96, Castaic 55, Acton had 37. Stevenson Ranch 34, and the broader Santa Clarita label had 28. Agua Dulce had 23. Those are the aggregate market counts. I'm not reading another seller's address, asking price, or sewing schedule into the broadcast. Active listings belong inside the authorized live search with current attribution and current status. If you want to see those individual homes and open houses, that's what Santa Clarita openhouses.com is built to do. So here, Our job is to understand the board without turning somebody else's listing into content. The last 30-day median sale prices showed how different these markets happen to be. Valencia was approximately 867,500. Saugus, 817,000. Canyon Country was about 732,500. Castaic was about 754,900. Newhall, 560. Acton, 867. Stevenson Ranch was at $1 million, and the broader Santa Clarita label showed approximately $1,450,000, but that figure came from only 3 sales. 3 sales are a conversation starter. They're not a market conclusion. Now, 3 people walk into a restaurant wearing cowboy boots. We do not rename the place a rodeo. Sample size matters. Price per square foot showed another split. During that latest 90-day comparison, divided into 2 consecutive 45-day periods, Valencia moved from roughly $412 per square foot to $438, an increase of about 6.3%. Castaic moved from $440 to $386, a decline about 12.3%. Canyon Country moved down from $433 to $407, down 6%. Saugus stayed nearly flat, $425 to $427. Newhall stayed at approximately $413 a foot in both periods, even while its median sale price fell. And that's the clue. So if this median price falls while the price per square foot stays flat, the value of every house did not necessarily fall. The mix of what sold happened to change. Smaller properties, condominiums, age-restricted housing, or a different concentration of transactions can pull the median around like a little dog dragging a large leash. The number's moving. The whole neighborhood may not be. Newhall gives us a sharper lesson. In the working sample of 60 active Newhall listings, 17 have been active for more than 60 days. 12 of those 17 were condominiums. That's about 71% of the longer market time group. Now, condominiums represented a little more than half of Newhall's active inventory, but they represented a much larger share of the listings sitting beyond 60 days. That doesn't mean Newhall's broken. It only means one product category is creating an undertow beneath the city average. A detached home seller and a condominium seller can live 2 miles apart and still be standing in different markets. Now, fold insurance into that condominium story. A buyer is not qualifying only for principal, interest, property taxes, and homeowners association dues. Insurance can now behave like the other association payment, except the amount may not be known until the carrier studies the property. With a condominium, the buyer who also needs to understand the association's master policy, the CC&R's deductibles, coverage gaps, lender requirements, and the separate policy for the unit. A low asking price can look attractive until the monthly obligations line up at the door. The mortgage has a chair. The association has a chair. Insurance pulls up another chair to the table. Suddenly, the kitchen table is full before groceries even get there. For detached homes, especially near brush, open space, older roofs, certain electrical equipment, some of these houses had aluminum, or a claim history, the same issue can even be more direct. A seller may have had coverage with the same company for years. That doesn't mean the company's going to write a new policy for their buyer. The existing policy belongs to the existing insured person. Now, the buyer generally needs a new policy and a new underwriting decision. A carrier can continue servicing old policies while declining to add a new one at an address. From the seller's perspective, the house appears insured, but from the buyer's perspective, the door may be closed. Both statements can be true at the same time. California's Department of Insurance tells consumers that an insurer has 60 days from the effective date of a new policy to verify rating and underwriting. That's why starting early matters. A binder produced during escrow is important, but the buyer should also understand that the carrier may still inspect and verify. The FAIR plan is available at an insurer of last resort when traditional coverage cannot be found, but it's not automatically the same as a standard homeowner's policy. The basic FAIR plan coverage is limited, and consumers may need a separate difference in conditions policy for gaps such as liability, theft, or water-related coverage. 2 policies can be required to create something closer to the protection people assumed came in one envelope. Well, that can change cost. It can change lender approval. It can change whether the buyer really wants the property. Now, here's what sellers should do with that information before the home reaches the market. Gather the current declarations page, the roof age, major system updates, claim information that must be disclosed or will surface through underwriting, defensible space work, and any documentation showing property hardening improvements. Do not advertise private policy details. Do not promise that the buyer can obtain the same coverage. Use the information to identify questions early. Ask what insurers are actively writing in the area. Ask whether the property has characteristics that repeatedly trigger inspections or refusals. Ask whether the buyer's agent or lender understands the insurance belongs near the front of the contingency investigation. A seller should not become the buyer's insurance broker. The seller should remove avoidable surprises. Now, the next point matters just as much. I don't represent buyers. If a buyer contacts me and the property has nothing to do with me, and it's not, or with one of my listings, I can refer that person to an independent agent. If the buyer is interested in a property where I represent the seller, I don't refer that buyer to somebody and collect a referral fee. I do not create a favor that can come back into the negotiation. There's no payback here. The seller hired me to protect the seller's position. That job should not have another hand reaching into it. I learned this before real estate. When I was a brand new police officer, I felt like I could walk into places in uniform and nobody wanted to let me pay. It was a meal or a cup of coffee, and back then, even a pack of cigarettes. I quit that habit years ago. I would always leave enough money to cover whatever I took because I didn't want to owe anybody. Free sandwich can become a hook with a string tied to it. Maybe nobody ever pulls the string, but I still don't want it attached. Real estate is full of softer versions of that string. I helped your buyer, so remember me on the next deal. I sent you a referral, so give my offer a cleaner look. I brought the lender the business, so maybe the lender can smooth something over. People can call that relationships, and relationships are valuable. Hidden obligations, though, those are different. If the award goes to somebody because a favor was owed, the person who did not know about the favor can pay the price. Sometimes that's the seller. Sometimes it's the buyer. But either way, the transaction has fingerprints on it that don't belong there. Seller's only agent is not a slogan wrapped around a normal real estate practice. It's the operating boundary. I don't represent the buyer. I don't practice dual agency. I do not collect a buyer referral fee connected to my seller's listings, and I do not trade the seller's leverage for future goodwill. One client, one direction. And that doesn't mean a hostility towards buyers. A qualified, well-informed, independently represented buyer is good for the seller. It means the buyer needs advice from somebody whose paycheck and loyalty are not tangled with mine. Clean lines make cleaner negotiations. Now let us talk about artificial intelligence without turning the show into a science fiction convention. I use AI to process public market information, compare neighborhoods, examine changes in property type, organize competitive patterns, and identify questions worth investigating. I also run locally installed AI systems, including Frank, yeah, I named it, for work where sensitive information doesn't need to be sent into a public chatbot. The point is not that a machine replaces judgment. The point is that privacy and processing power can exist in the same room. A locked file cabinet is useful because it's locked. A fast research assistant is useful because it's fast. Put them together carefully and a seller gets deeper preparation without having personal information scattered across public-facing systems like ChatGPT or Claude. The narrow application matters. I'm not asking AI to decide what your house is worth and then saluting the screen. I'm asking it to help sort hundreds of records, compare recent periods, flag a strange divergence, and show me where to look harder. If Valencia's median sales price stays flat while the price per square foot rises, that deserves attention. If Newhall's median fails while price per square foot does not, well, that deserves attention as well. If a stale inventory concentrates in condominiums instead of houses, that also deserves attention. AI finds that smoke. Experience decides whether it's a fire, a barbecue, or somebody burning toast again. That's how we study affluent neighborhoods and specialized buyer pools without pretending every expensive home is the same. A custom home in Sam Canyon, a gated property in Westridge, an estate in Newhall, and a newer luxury property in Valencia can share a price range while attracting different buyers for different reasons. lot utility, privacy, schools, commuting patterns, insurance, architecture, association rules, fire exposure, new construction, competition. A broad luxury average can be as useful as knowing the average shoe size in a restaurant. I know I was going to shoe size in the seashore. It's a number. It doesn't tell us which pair fits. Even though I don't represent buyers, sellers need disciplined buyer's intelligence. We need to know what buyers can finance, what monthly payment they are comparing, which features create urgency, which obstacles create hesitation, where those buyers are searching and other properties compete for the same attention. That is not buyer representation. That's seller preparation. A football defense studies the offense. It doesn't switch jerseys. Mortgage rates remain part of the payment calculation. Freddie's Mac's last weekly survey, released August 20th, placed that average 30-year fixed mortgage at 6.65% and the 15-year fixed at 5.95%. The 30-year rate was down slightly for the second consecutive week, but it remained a little higher than 6.58% average from the same time a year earlier. Lower than last week doesn't mean inexpensive. It just means the headwind softened slightly. For sellers, the buyer's monthly payment still controls the size of the audience more than most national headlines do. Add insurance and association dues, and a modest change in one category can push a buyer across that qualification line. Now, here's the practical seller checklist for today. First, identify the real competitive category: house, condominium, townhome, age-restricted property, new construction, alternative, or acreage. Second, calculate that payment pressure a buyer will see. Not just the asking price, but mortgage, taxes, association obligations, insurance, and likely special assessments, any of those that exist. Third, investigate insurability early enough to answer questions without making guarantees. Fourth, make that property easier to underwrite where reasonable. Documentation and roof information, electrical updates, brush clearance, and completed maintenance can matter. Number 5, will keep representation clean. The person advising the seller should not be building a side benefit from the buyer. Now, number 6, use technology to find patterns, then verify every conclusion with the real records and the people who carry the licenses for insurance, lending, title, and legal advice. 3 things to remember. 1, Santa Clarita is not one market. Property type and neighborhood can split the valley into completely different seller experiences. Number 2, insurance is now an early transaction issue. A seller existing policy doesn't guarantee that a buyer can obtain a new policy from that same carrier at the same cost or on the same terms. Number 3, information is only valuable when it changes preparation. A market report that never reaches pricing, insurance, presentation, negotiation, or exposure is still that unplugged toaster. Pretty shiny, but you get cold bread. If you're considering selling, the question isn't simply, what did the house down the street sell for? The better question is, what can the next qualified buyer actually purchase, insure, finance, and choose instead of your home? Well, that's where that real market lives, not in one headline, not in the median, not in the decision the next buyer has to make, but in those decisions all the buyers have to make. For live Santa Clarita homes and open houses, go to santaclaritaopenhouses.com. Lots of information there. For seller representation, go to sellersonlyagent.com. If you want those real numbers for your property and the risks we should solve before the sign goes up, text HOUSE to 661-400-1720. I'm Connor with Honor, licensed and serving Santa Clarita homeowners since 1998. Yeah, here we go. Sellers only agent, one client, one direction, no favors owed. Thanks for watching. Be well. We'll see you in the next one.